You do this. Okay, let's go. Good. Okay, chapter 3. Now that I have to introduce it the second time. Chapter 3 is about the income statement. We've already looked at, transactions, how they get recorded, how to analyze them. Chapter 3, we're going to focus just on what happens with revenues and expenses. Sound good? Okay, off to a start. And I didn't unlock the back door. So we're going to focus on the transactions that we've been recording, how those affect what happens on the income statement, how it affects revenue, and timing, because under GAAP, you get a different response than if you do it under what's called the cash basis, and I'm going to talk about that tonight as well. We're going to make sure that we measure transactions appropriately, and we're going to make sure they're reported correctly on the income statement. So we did a basic income statement for the first exam. We're going to start to expand it a little bit and talk about more elements that go into an income statement. So, concept, we got to talk about operating cycle. Normal business, it's a business. They do something, and they do it over and over and over again. And that's their operating cycle. So think about it in terms of something you know. Somebody name a very common product or company.
Coca-Cola.
What? I heard Walmart. I need a product, really.
Coca-Cola.
Coca-Cola. There we go. We're going with Coca-Cola. So the operating cycle, you start at the beginning. You get your raw materials. You bring them in and you manufacture your product. So if you're Coca-Cola, you're out getting what all the secret ingredients are. I'm sure there's some sugar in there, and there's, whatever makes it brown, and the carbonation, and you're going to need bottles and caps and labels and all that stuff, right? So you get your raw materials, you bring it in, you make the stuff, you pay your suppliers, you go deliver your product to the stores. The stores pay you for the product. You go buy more raw materials, you make more stuff, and you go through the cycle. So the business cycle is different from the accounting cycle in that the accounting cycle is typically what? A month or a year. Sometimes it's a quarter, 3 months. The business cycle, you could do this how many times a week? 3, 4, 5, 10, 50. Have you ever watched those programs like How It's Made or something like that on the History Channel? You see those big conveyor lines where they're making, Twinkies, and you see millions of them just coming off of the thing. So, how fast can they go through the cycle? Pretty darn quick. Everybody good with the cycle? Okay. Ooh, everybody nodded tonight. We're off to a great start. The operating cycle, like I was saying, can happen very quickly, or think about the other side of it. What if you're Boeing and you make airplanes? How long does it take you to make one of those big airplanes?
2 weeks.
Yeah, it might be a year, might be 2 years. I don't know for sure. But in that case, the operating cycle is a lot longer than the accounting cycle. So think about the impact of that. Let's talk about Boeing for a second. We're making an airplane. So we spend money on all these airplane parts, and we spend money on rent for a big building, and we pay people, and they're putting this airplane together, and a whole year goes by, and we have a couple of wings, some landing gear, and some seats bolted inside an open frame. Okay, the whole year's over. We have an issue here. What do we recognize there? Do we record the expenses and report that on our income statement? That's the question. Have we earned any revenue? Remember, under GAAP, we have the matching principle where you want to match the expenses with the revenue that it generates. Well, have we finished the airplane and delivered it to a customer? Have we earned any revenue? Okay, something to think about. And if you have partially completed items like that, how do you measure what expenses or what revenue that you're going to record? So there's some considerations here. Let's do a little Remember how I said accounting's its own language? Let's do a little language lesson here, learn some words. We've talked about this before. Revenues, right? We make a sale. Revenue and sale are pretty much the same thing. So if we're in the business of making these and we sell them, we've created a sale, right? We've made revenue. An expense is, well, here's the technical definition: increase in assets or a settlement of liabilities from ongoing operations. Expenses, we have to pay for rent, we have to pay our people to sit in the store and wait for you to come in and buy these things, and we're selling them. Those are our expenses related to selling this item, right? There's another word, gains and losses. We may have brushed on this a little bit before, but I want to reiterate to make sure it's cemented in your head. A gain is a lot like revenue, a lot like a sale, except it's a gain because it's revenue from something that you're not in the business of doing every day. Okay, so say you're Boeing and you make airplanes for a living. So when you sell an airplane, you get revenue. But today, instead of selling an airplane, we have an old welder that we don't use anymore because it's outdated, and we use some new automated mechanical robot thing now. So we sell the welder. Is that revenue? Sorta, but we're not going to call it revenue. It's cash coming into the business, yes. But we're not in the business of selling welders or equipment. So it's other income. And because it's other income, we now call it a gain as opposed to revenue. But it's still cash coming into the business. Everybody good with the concept? Okay. A loss.
It was a no.
What? Go ahead.
Oh, I'm sorry, I heard a no.
Somebody say no?
No, I said yes.
Oh, okay. She was turning you in. Yeah. A loss is if let's say we paid $100 for that welder and we sold it for $50. Did we just lose money? Yes, we did. So you've now told people which direction it went. We've suffered some sort of a loss. We didn't get all of our investment back. Or a loss can be something else, like we have a delivery truck and somebody stole it, and for some reason we don't have insurance, right? If insurance pays us, we're fine. We're not out any money. But if we don't have insurance, we just lost whatever we paid for the truck, correct? Question?
So, if you sell the welder and get money for it, that's a gain, but it's not as much money as it was worth.
If we sell the welder for more than we paid for it, we have a gain. If we sell it for less than we paid for it, we have a loss. Now, that's the easy way to look at it. Something called depreciation comes into play later. I'll explain it to you, not tonight. Okay? Good? All right. So that's gains and losses as opposed to revenue and expenses. Everybody clear on that one? Good. Okay, so here's a nice example of an income statement. Operating revenues. Operating is the key word. This is the business we're in the business to do, right? Restaurant sales, franchise fee, total revenues. Operating expenses. This is what it cost us to generate these revenues. Pay our people, rent some buildings, administrative overhead, advertise, total expenses, operating income. This is how much we made from the business we're in every day. Then we have other stuff. We went out and bought some stocks and we sold them at a higher price. We got some investment income. We borrowed money from the bank. We had to pay interest on it. That's not part of our normal operating function, so it's an other expense. And here we are, we sold a restaurant. This is Papa John's. They run pizza places. Are they in the business of selling restaurants? No, they're in the business of making and selling pizzas. So when they sell or close one of those restaurants, it's other income. It's a gain or loss as opposed to revenue or expense. So that's the summary of what other income is. I think we've been through that a little bit before, but I just want to hit it again. Yes, sir. False start, 10-year penalty. Okay. Questions? Anybody? Anybody else? Yes, sir.
So we're looking at specifically what the business is intended to do. So if it's a franchise, they...
Selling franchises
Oh, I see.
is our normal business. Okay. Everybody good? Yes.
Gains and losses are always in the other category.
Always part of the other, part of the non-operating section of the income statement. Okie doke? Okay. So I just want to hit on this. Revenue, you always show as total revenue. Cost of sales is almost always your first item in your operating expense section, and a lot of times it gets its own section in the income statement. When we did Accounting 151A, we actually built the whole cost of goods sold, and we had the whole cost of goods sold section. And you can see that it's the largest single expense up here, usually followed by wages. So what we paid for, let's talk about bookstore for a second. We bring in these books, we put them on a shelf, we sell them to people. What's our biggest cost? What we paid for the actual books, right? So, cost of goods sold is important. It's also used as a metric, and have we hit this one yet? I forget on a Wednesday night. Gross margin. Revenues minus cost of sales gives you gross margin. And that, calculated as a percentage of revenues, tells you the gross margin percentage. It's one of the key metrics that we're going to use to analyze our companies in the project. Okay? All right. Skipping that. Okay, here's where we got to stop for a second. We talked about GAAP, generally accepted accounting principles. Yes? Under GAAP, you're supposed to match the costs of generating a sale, right? You're going to match the costs with the time period that you generate the revenue. It's called the matching principle. And because of that, we use things like accounts receivable and accounts payable, right? So let's kind of think through this concept. We run a bookstore. If I sell you the book, I'm going to sell you that book for, say, $100, right? So I get revenue. Is revenue a debit or a credit? Revenue increases on which side? Credit. I sell you the book for $100. If you pay me in cash, cash increases as a debit. Good? Okay. What if you don't pay me in cash? What if I let you sign for it and tell me that you're going to pay me in 30 days? What do I get instead of cash? I get an accounts receivable. Is an accounts receivable an asset or a liability? It's an asset. So I get a $100 asset. Did I get cash? No. Okay. This is GAAP. This is the matching principle. I record the revenue even though I didn't get cash. The transaction's complete except for you haven't paid me. Everybody see that? So later on, you're going to come down and you're going to pay off your account receivable. You're going to pay me the cash, and I'm going to go ahead and credit this and take your balance to zero. But this is a separate transaction than the first one. So the first one happens today, the second one happens in 2 weeks or 30 days. With me so far? Now, I need another color. In cash basis, let's treat this separately. If this was cash basis, I make the sale the same day I get the cash. And the green marker is yucky. I don't have green,
Red.
but I have red. So in a cash basis, you record the sale, you also get the cash. Now think about it. In cash basis, if you come in and I say, hey, Louisa, I've known you for a while, I trust you. Here, take the book, you owe me $100, come back and pay me next week. What do I record in my accounting system on the cash basis? Nothing, not a thing. I don't even write down somewhere that she owes me $100 in the formal double entry accounting system. I may write it on a piece of paper so I don't forget, but there's no entry in the accounting system. Whereas in the accrual system, you record it no matter what, and you record the receivable. It's a very significant difference. You guys follow with me so far? You guys in the back? Good? Okay. So that's cash and accrual. And this explains the matching principle. Here's the key. Transaction is recorded. Revenues and expenses are recorded and recognized when the transaction occurs, not necessarily when the cash changes hands. Okay? So think about it with an expense. Under the accrual method, if I run a bookstore and I leave the lights on all month and I've been open, at the end of the month I know I'm going to owe something for the utility bill, right? But the bill hasn't come yet. It usually comes in a couple of days after the end of the month. I haven't paid it yet. Under accrual, I would record that expense. Under the cash method, what would I record? Nothing. Good? Okay. So, in order to record a sale, 4 things need to happen. All 4, not one of them, not 2 of them, not 3 of them, all 4 must occur. So think about this like with Boeing. Delivery of the product or service has to have occurred. So if I'm Boeing and I'm making an airplane, have I delivered the airplane? No, it's only halfway done, right? There's persuasive evidence that there's an agreement that you're going to buy it from me. Boeing doesn't start building airplanes just because they're going to park them on a lot somewhere and put a for sale sign in them. They have a contract before they start. So that contract is the persuasive evidence that it's sold. There's a contract. The price is fixed and determinable. We've already negotiated the price. The airplane is going to be $100 million. And you put the price in the contract. Collection is reasonably assured. So, Louisa, I'm going to pick on you tonight. If Louisa walked into my office, and I'm the sales guy at Boeing, and she says, hey, I want to buy an airplane. And I go, okay, what company do you represent? No, it's just for me. I'm going to commute to work with or school with it. Right? I live in Santa Cruz. I gotta get to Cabrillo every night. I want a 737. Am I going to go and have her sign a contract and build her an airplane? Am I reasonably sure that she's going to be able to pay me? I'm going to do my homework and find out if she's got that kind of money, right? Is she a good credit risk? And if she is, only then can we satisfy all 4 criteria. So there have been cases in the past where someone would record sales to a customer they know would never pay them, so they can artificially pump up their sales. But it's bogus. It's not ever really going to happen. They'll never get the money, right? Okay. Questions on that? You're going to have to kind of remember the 4 key elements. Everybody with me? We started strong. Don't fade on me here. Okay. So, here's another concept. I want to talk about this in terms of what we did over here, though. Where's that red marker? I'm going to erase this. See if we can knock out a few slides easier, because the book can sometimes be a little confusing. we can receive money from customers at different times. Typically, if you walk into a 7-Eleven and you buy a Coke, what happens? You walk out with the Coke right after you give them cash, correct? So they're going to record a sale of $2 and cash of $2, rounding, no sales tax, any of that. Everybody with me? So that way, the product and the cash change hands at the same time. We've already covered the second option. If the product, if I sell you the book for $100 and you don't pay me until later, we use accounts receivable, correct? And then later on it becomes cash. So the second one is if we get the cash later. The third one is, think about this all of a sudden. You all just finished college and passed the bar, you're attorneys. Okay? Somebody walks into your office and says, hey, I want to sue somebody. The first thing you say is, I need a retainer. You're going to give me the money up front. Right? This is the business to be in now. Think about this. So if someone's going to pay you up front, do you have any revenue? No, I haven't done the work. Remember the 4 criteria. I haven't provided the service. So what I'm actually going to get is unearned revenue. Now, I want you to not get confused here. We can almost ignore the word revenue. This is a liability account. I have unearned money that someone else gave me. And this is an attorney, so let's use, realistic numbers. Okay? And I get cash. Good? Bless you. Bless you. This is a liability account. It would go on my balance sheet under the liability section. And it's unearned and it's a liability. Why? Well, if this person asked for a refund, theoretically I would have to give them the cash back. I'm an attorney, so we know I'm never ever going to do that. Right? But the same thing holds true for magazine subscriptions. You send in your, whatever it is, $50 for a year subscription to People magazine. It's unearned until they send you the issues, the 50 issues or 26 issues of People magazine, right? So they get the cash, but it's unearned. And then over time, what happens is, let's say I'm the attorney and I do a bunch of work for you and I send you a bill for $5,000. I offset it against the unearned and I record the revenue at that time, but only after I've performed the service. So there's 3 times when we can record something. Money and product change hands at the same time. Product is given to the buyer, we get cash later. Or we get cash first and we provide the product later. Okay? And that's how it works. Either you use AR or the unearned revenue. Cool? All right, we'll work through that one a couple times because it can be a little challenging. Same example, just slightly different. Examples of unearned revenue. Remember we talked about landlord asking for a deposit up front. So if you pay the landlord for a year in advance, to him that's unearned. It goes in a liability account. And then as every month goes by and you've used up part of the rent, then it becomes rent revenue to them. Subscriptions is another one like we talked about, People magazine or whatever magazine you are into. I can't think of any others off the top of my head. Print is dead, right? We all read it online now. Yes, ma'am.
So what if you have like a contract with someone that says like I'm doing a project for you and you need to pay me up front, but that even though it's unearned, would you still record it under the unearned, but your contract says you're going to pay it anyways, even before? Is that like that?
Okay, let's jump into what I think is an answer to your question. I'm still going to work with those 4 accounts because it works. I'm Boeing, and you want to buy an airplane. So the airplane is $100 million. Let's make it easy. The airplane's $100,000. I want $50,000 up front. So I'm going to have unearned revenue of $100,000 liability, so it's a credit. I'm going to get $50,000 from you. Oops, I apologize. I just did this wrong. I get $50,000 from you. My unearned is only $50,000. When I'm done, when it's all over, I'm going to have revenue of $100,000. I'm going to get another cash of $50,000, and I'm going to make this go away because I've earned it now. So 50 debit equals my 100 credit. So there's some of both. You pay me up front and you pay me after. Okay?
That makes sense.
Yeah.
So what if the transaction happens at the same day? Like, say you take a deposit or something
Okay.
at the beginning of the day. We're providing the service throughout the day. And at the end of the day, they come in and pay balance.
Okay.
It's
How much
clear.
spare time do you have to record transactions?
It's not like we're
Yes.
recording those transactions. They're getting recorded in the system, but they're not getting recorded.
You know, if you're using a computerized system, you know, like at point of sale at the cash register, so I'm going to collect cash from you. It's going to record this. It's going to record the cash you put in the drawer and the liability, and then at the end of the day, you're going to record the sale, offset or increase cash and offset your unearned. It'll do the same thing. But unless you're on a computerized cash register tied in with your accounting system, you'll probably just show it as one transaction, revenue and cash on the same day. Okay? Yes, ma'am.
How would you record, for example, in the contract where you get cash now and then cash later on a cash basis? Would you record it when you get that retainer? Or would you
I'm going to run out of colors. Hopefully purple is just different enough from blue that you can see this. Okay, so the question is this. We sold an airplane for $100,000. We've got 50,000 deposits. We got 50,000 unearned, 50,000 cash. Later on, we complete the plane and we deliver it, so we get the full revenue of 100,000. We get another 50,000 in cash, and we eliminate the unearned revenue. How would that transaction look different if it was on a cash basis, right? So I'm going to do it in purple. What we know is we got cash, right? I'm going to erase some of the rest of this. So you walk in to buy the plane, you give me 50,000 in cash. Have I delivered the airplane yet? Now what do we do? Now, but if it's truly a cash basis approach, do you have unearned revenue? You don't have an accounts payable. I can't record it as a payable. Technically, I don't have those kind of liabilities to record it as. I think I would still record it as unearned revenue. I haven't completed the sale. I truly can't come over and record it as revenue. That's a great question. It's a sticky question. I would still come over and try and record it as unearned revenue. You've kind of got a hybrid situation there. Fair enough?
Does anybody use cash basis system?
Yeah, a lot of small companies use cash basis. And actually, if you, on the front page of business tax return, there's a box that says accounting method, cash or accrual. And you tell it. If you mark cash when you fill out the page for a balance sheet, you better not have accounts receivable though. Okay? So just a word for the wary. So I'm sorry, but I think you got me in a situation where I don't know what you would do. I've not ever seen that one. Sir?
So a true cash basis, you wouldn't even record the $50,000 cash.
Well, I think the more I think about this, on a true cash basis, would you give me cash before I gave you the product? And I think that might be what it comes down to. Maybe that would not happen. I mean, it's almost like a barter system where you're going, okay, I'll give it to you when you let go, sort of thing, right? All right, other questions? Yes, no? No? Okay. Let's see. So we talked about accounts receivable, collecting accounts receivable. All right. This is a funny slide. So matching principle, the concept is recording the expense in the same time period that you generate revenue from that effort. Okay? So if I pay the rent for the bookstore for the month of February, I want to record that expense in February when I sold all those books, right? So I'm matching the revenue with the time period, with the expense with the time period it generated revenue. I don't know what that has to do with this guy getting punched. So they're matching black eyes, yes, okay.
It's a boxing match. Matching.
Got it. Well, I hit you, you hit me, yeah. I don't know. So, again, since I like doing it my way, now we're dealing with expenses. So I don't have revenue anymore. But what do I have? I now have expenses, correct? And I'm just going to record it in one category called expense. So if I buy something from you and I get the product and I pay for it at the same time. Say I buy books for the bookstore. I walk into your warehouse and I buy a box of books and I pay you cash and I walk out with the book. I have an expense, right? Expenses are debits. And I give you cash. Cash goes down. So that's where cash changes hands the same time the product changes hands. What if I walk into your warehouse and I buy a box of books, but I promise to pay for them later? It's not an accounts receivable, it's an accounts payable, correct? A liability. So I have, in that case, I have an expense, and I've promised to pay for it later. When I pay for it later, I reduce cash, and I wipe out the payable. Good? Okay, now what about if I make a deposit on an airplane that you're going to deliver to me later? Let's do it an easier one. You make me pay 6 months of rent in advance. Fair enough? What do I have there? Prepaid rent. So prepaid rent is what? An asset or a liability? Asset. So if we prepay a year, let's call it $12,000. It's $1,000 a month. I've given you the cash already, though. But what do I not have at that point? It's not an expense because I haven't used it up. January 1, I pay you $12,000. Have I used a year's worth of rent yet? No. Have I used a month's worth of rent yet? No, not until the end of January, right? So at the end of January is when I would record the expense for 1 month. 1/12 of this, and I would reduce the balance in my prepaid by 1/12, or $1,000. So my remaining balance is $11,000. That's 11 months worth of rent. Good?
Yeah.
So that's the flip side of it. On the expense side, how the three types of transactions work. Payment at the same time that you get product, payment after you receive product, and payment before you receive product. Sir?
So, as you are recording the prepaid rent, the landlord is recording the unearned.
An unearned revenue. Absolutely. That's great. Other questions? Who's confused like me? Not that kind of confused. Yes?
I was saying, I was confused like you.
Okay.
I'll actually ask a question at one point. You'll just-
No, please, let's get through it. I want to, if you and I are confused, other people are as well. So let's work through it.
I suppose I'm trying to figure my question out in my head, but say you're Boeing, you're making an airplane, it's taking you more than a year,
Yes.
and the utilities or something, yeah, I suppose the utilities you're using to make this airplane,
Mm-hmm.
do you record them as an expense a year later after this airplane is made? Like administrative expenses, how do you attach them to a product? How do you attach
Okay.
them to?
There are some variants of this. What you do with these long-term contracts is you'll take all those utility bills and the wages and you'll accumulate them. You'll capitalize them as if it was a big piece of equipment you were buying. And then when you get the revenue, you take all of those and you offset revenue minus all the expenses at one whack. Bang, you're done.
Okay.
Okay? Or something that happens with like big bridge, when you build a big bridge or a highway or a dam or something, percentage of completion. Oh. Okay. Then that's okay. So yes, we can look at a couple of homework examples specifically. Keep an eye on that, because I don't know if that one's a good one or not. All right, so what homework problem did you want to ask about? And what page is it on?
141.
Page 141?
Yeah. And it's 3-3 D through F.
What? Not yet. So page 141, problem what?
3-3 D through F.
Okay. Remember, I have version 7. So do you you have version 7? Okay, we're going to work off of version 7, okay? So, identifying revenues. Revenues are recognized when delivery of goods has occurred, there's persuasive evidence of an agreement, the price is fixed or determinable, and collection is reasonably assumed or assured. The amount recorded is the cash equivalent sales price. The following transactions happened. So you want to do D.
Yeah.
Macy's department store orders 1,000 men's shirts for $15 each for delivery, future delivery. The terms require payment within 30 days of delivery. Answer from the manufacturer's viewpoint. So they ordered shirts.
So it says we have to indicate the account, revenue account, title, and amount.
Okay, well, let's just kind of talk through this a little bit, though. They're going to buy Macy's is going to buy from us 1,000 shirts for $15 a piece. Good? Have we determined the price? Is collection reasonably assured? It's Macy's, they'll probably pay us. Have we delivered the goods? Have they made payment?
No.
So what do we record? We don't have a liability. We don't have an asset. There's nothing to record there, right? You guys see that? Questions on that? Kind of.
They give that as an option as an answer.
This is a trick question, is an option?
No, they say no revenue is recorded or recognized is one of your.
Okay. E, the manufacturer completes production of the shirts described in D above and delivers the order. So once we've made delivery, at that point we've made delivery, the price is fixed, collection is reasonably assured. What's the fourth item? We have an agreement, right? So at that point we record this as a sale. And did we get cash? Well, no, it says in D that the terms are payment within 30 days. So that's in accounts receivable, right? So yes, that one works. We're doing Chapter 3 homework already? What? It would be next week. We're doing your homework ahead of time here. Whoops.
Really?
Yeah, she's doing it ahead of time.
Homework's been so stinking hard.
I don't expect you to do it until after we cover it in class. Hey, go do the homework and then I'll tell you about it. Fair enough? All right. You want to keep going or you want to wait? I don't mind. Let's do it. Yeah. F. F. The manufacturer received payment from Macy's for the items in D and E above. Okay, so when we get cash, we get cash. And we get cash, what are we giving up? Accounts receivable is going to go down, right? Cool. Everybody good at this? All right.
So when we got the accounts receivable, that went up, but what went down?
Okay, hang on. Let's do the transactions. I'm going to erase here. And I've got to change some titles. All right, we have revenue. We have cash. We have accounts receivable. Okay? So the first thing is Macy's comes, they place an order. 1,000 shirts at $15. Do we record anything? No. Right? That's D. E is we deliver the shirts. So we go over to Macy's and we give them the shirts. $15,000, and they give us an accounts receivable, i.e. a promise.
Other side.
Oh, apologize. My fault. Apparently, don't trust my work after 7 o'clock. It's not 7 yet. Uh-oh. So we get the revenue because we delivered the shirts. The price is fixed. Reasonable assurance we're going to get paid, so we record it as a receivable. Okay. 30 days comes by. They pay us the cash. Cash goes up. AR goes down. So we end up just like if we had made the sale and received cash on the same day, but it happened 30 days later. Okay? Other questions?
And then that's when we record it. Once we have the cash.
Please clarify it. When we delivered the shirts, we record the revenue. Because we record the receivable. When they pay us, 30 days later, we get cash, and the receivable goes away.
But the receivable is still an asset.
Until they pay it.
It's not liquid.
Correct. It's not cash, but it's a receivable. She wants to ask another question.
No, I'm okay.
Okay, think about it this way. Let me segue a little bit. Remember I said cash is king? Companies that make profit sometimes go out of business because they don't have enough cash to pay their bills. Well, think about it. We generated a sale. We provided the goods. We had a contract. We're pretty sure we're going to get paid. So we record revenue and accounts receivable. Yes? So let's say Macy's doesn't ever pay us. You know, oh, gee, we'll pay you later. We'll pay you later. We'll pay you later. I have to pay my employees. I have to pay rent. I have to pay utilities. 60 days goes by, they haven't paid me. I have to have paid my bills by now, right? People are hounding me. 90 days goes by. You know, my creditors are starting to, you know, the landlord's going to kick us out. They're going to shut off the power. I could go out of business here, right? My employees won't come to work anymore because I'm not paying them. But I still have positive net income. I still have a receivable, which is an asset. But I can't pay my employees with an accounts receivable. Does that help?
Yeah.
Okay. So it's not until later when I actually get the cash and the receivable goes away that I pay my bills. Yes, sir. All right, stop it again. Okay. We're back. Questions, anyone? So, better?
I was confused with the cash method.
Got it. Okay.
That's what I was confused with.
Yeah. So we're focusing on accrual here. Because most people can figure out the cash part of it. Right? That's what everybody does because it's simpler. Accrual is actually accounting for things and matching the revenue and expenses, even though cash didn't change hands. So, okay. Other questions? Moving on. So that's what we just went through. Matching principal, payables. All right. So examples of this are, you know, if we buy things for our business and we promise to pay for them later, they become accounts payable, right? If we pay for insurance in advance, things like that. I'm going to let you guys read about that. All right. Does everyone remember this?
Yes.
This is our friend, right? This is the full accounting equation. Well, no, this is the short accounting equation. The full one's coming up in a moment. Assets, liabilities, stockholders' equity. Everybody remembers I put up a slide where it has the 6 different types of accounts. Which ones increases debits, which ones increases credits. What are the 3 types of accounts that increase as debits? Assets, expenses, and? Well, that's an asset. Yeah, it's any type of dividend. Dividend, right? Okay. Which 3 categories increases credits? Liabilities, revenue, and stockholders' equity, which is both contributed capital and retained earnings. There's 2 segments to stockholders' equity.
So does revenue fall into the same chunk as retained earnings? In this equation, could you point to where revenue lives?
Let me write it up on the board over here. Okay. Assets equals liabilities plus stockholders' equity. Revenue is part of stockholders' equity. Expenses are part of stockholders' equity. So revenues will increase retained earnings. Expenses will decrease retained earnings. If you look, this gives you net income. So positive net income increases retained earnings. Net loss decreases retained earnings. Okay, so that's how they all piece together. Just remember that contributed capital is what was paid for the stock, and retained earnings is the accumulated earnings and profits over time, less the dividends that have been paid out. Okay? Good, good? How about you guys with the good seats in front? Nod your head yes or no? Okay. So, I think we just covered this. Okay, there's even a slide for that. So dividends decrease retained earnings, net income increases it, net loss would decrease retained earnings as well. Good? Revenues minus expenses is the definition of net income. Yes? Okay. Okay. This is, let's do some transactions, just so that we all get a little bit more comfortable with it. Fair enough? All right. Pretty straightforward. The book uses Papa John's as our example. They sell pizza and they sell supplies to the franchisees. Everybody know what a franchise is? Just for those of you who may not, McDonald's is also a franchise type thing. I think Burger King is as well. A lot of big companies that, what? Subway, Jamba Juice. A lot of these big companies, you'd be surprised, are not owned by the parent company. They're owned by individuals. So let's say we wanted to start a McDonald's. I go call up McDonald's and say, hey, I want to open a McDonald's in wherever. Okay, Aptos across from Cabrillo College, right? I'm gonna buy where the farm is, and I'm gonna build it there. Fair enough? Like that would ever happen. The county boot me out so fast. McDonald's says, it's a turnkey situation. They give you the equipment. They train you how to make Big Macs, right? Every McDonald's you've been in, they're the same, right? There was a comedian that did a joke. Going to McDonald's was like, they have one big vat with secret goo and they just have a mold, right? You want a Big Mac? Big Mac. Milkshake? Milkshake. You know, it's cookie cutter. No matter where you go on earth, they're the same. And that's what the franchise is. They teach you how to do that so you don't have to reinvent the wheel, and you have a higher likelihood of making a profit. In exchange, they charge you something for it. So in this case, Papa John's sold pizzas for $36,000, and they sold supplies to the franchise guys for $30,000. Good. So we have revenue of $66,000, 36 plus 30. We got some of it in cash. They've lost me. Receiving $21,000 in cash and the rest on account. So in my mind, the cash should say $21,000, right? Love it when the slides are right.
They're combining. No, at the top it says $36,000 cash.
Oh, okay, so it's 21 plus 36 is the 57. Got it. Which means the franchise guys owe us $9,000. Let's make it tough, right? Everybody follow how that works, though? We sold this. They paid us part of it. The rest we'll get later. But those are both assets, cash and the receivable. Fair? Okay. Let's see. So we buy some supplies that we're then later going to sell to the franchise guys. We bought the supplies for $30, and they go into the supplies category for $30. Good? Okay. Everybody follows this pretty good? Let's see. We sold franchises for $400. Cheap. I'm sure it's $400,000 or $4 million. We got $100 immediately, and the rest we earn later. So they paid us up front. Here's a cool one. They paid us $400 in cash. We gave them the franchise, and we gave them some supplies and some training worth $100, and we have to provide the rest of the training and supplies next month. See how that works? We got the cash. We earned $100. The rest of it is a liability and unearned revenue. Everybody follow? Anybody not sure? Okay, help me understand. Help me understand where I have failed you.
I'm really just trying to grasp everything that's been going on the last hour. I
gotta go. He just deflated my whole day.
When you do it on the board, I understand. For some reason, the slides are confusing.
Okay. Let's do it on the board. Okay? Yes, sir.
I think that, because I had the same problem, is where I think we're talking about cash, basis, and then I see an accounts receivable, so it's like,
We are not at any time talking about cash basis. I just wanted to explain to you what cash basis was and what the difference is between accrual. Everything we do is going to focus on the accrual basis of accounting. Good? Okay. So, in this case, let's even use their data. We sold a franchise to some guy. He wants to build a Papa John's. We sold him a franchise. So, we made him pay for it up front. He gave us $400. Awesome. Do I have revenue? I haven't done anything for the guy yet. Okay? So let's record it as unearned revenue. $400 liability. Okay? This is January 1. During January, we finish the contract. He comes in for training. And we teach him, here's how you make pizzas. Here's how you run the business. Here's, how to do the marketing and all that. So we actually do one quarter of the training. So we've earned $100 worth of the $400 now.
Okay. So where does the other 300 get reported?
It's still over here in unearned revenue.
It's just what's left.
Right. So I just showed you the two steps of the same transaction. What they're doing is showing it to you as one step. Okay? We got $400 in cash. I earned $100 worth of revenue because I trained him a little bit. And I owe him the rest later.
So without, they're just not reporting under revenue, it's just kind of a given, like, okay, 100 gone, 300.
Well, they are recording it.
Okay.
It's just what they did had to have happened on 2 different days. You didn't get cash from the guy and then train him 25% of the way all in one day. Okay? So they're showing it to you like it happened all in one day, and I just broke it down into the 2 transactions that happened. But they're going, cash, trained him, I owe him the rest later.
That makes sense.
Does that help?
oh, this? Yeah, no, it makes sense when I'm thinking about it in the accrual thing, but I was expecting cash, so.
Okay. Any other questions? Okay. Let's see. Papa John's paid $7,000 for utilities, fuel for vehicles, blah, blah, blah. So we record our expenses, right? Expenses are debits, and we paid cash. This is where we pay and we get in exchange at the same time. No payables, no receivables, no unearned, no prepaids. Good? Sir?
This format that they're using is very close to it. It's like a journal entry.
That is a journal entry.
Cool.
Yes. Okay? So here's the account name, we debit that account. Here's the account name, we credit that account. Fair enough? Okay. I'm skipping that. Okay. So remember, how many financial statements are there? 4. And they are prepared in a specific order. Income statement is always first, because you need net income to move on to the statement of stockholders' equity. Revenues minus expenses gives you net income on the income statement. Statement of stockholders' equity is beginning retained earnings plus net income minus dividends gives you ending retained earnings. Stockholders' equity is what you paid for the common stock goes in there as well, but it's its own account, not retained earnings. The balance sheet is prepared third. Assets equals liabilities plus stockholders' equity, which you need the ending retained earnings to complete this. Stockholders' equity is the contributed capital plus the retained earnings. Statement of cash flows is the fourth one. Remember, it's broken down into 3 segments, not 4, 3. Cash in or out of the company from operating activities, cash in or out of the company from investing activities, cash in or out of the company from financing activities. Okay? All right. And the ending cash that is derived from this should match balance sheet. Good? Okay. Oh, there's the roadmap. I knew that was coming and I did it anyway. All right. So again, here's an income statement. Notice they've got accounts with zero balances. You'll never see an account in a formally published income statement or balance sheet with a zero, right? They're usually just omitted. If you work in a small company and the computer system prints them automatically anyway, that's about the only time you'll see them. Stockholders Equity. I like this format. It makes it very clear what's going on. So we've got Papa John's Statement of Stockholders Equity for the month ended January 31. Who, what, and when. Beginning balance December 31, contributed capital. Here's what people had paid for the stock. We sold some more stock. And we have an ending balance of contributed capital of $9,000. Good. Retained earnings right next to it. So you can see that side by side. Beginning balance of retained earnings. Stock issuances don't go there. Net income, though, increases retained earnings. We declared a dividend that would reduce retained earnings. So you do the math and you're ending retained earnings. Total stockholders' equity is the combination of both of these contributed capital and retained earnings. Bang, you can see that your ending balance in total stockholders' equity is $150,000. That's a pretty slick layout. Not that you have to use it, but it works. Good? Questions?
Opposed to listing those underneath versus side to side?
Or you would end up going and doing contributed capital all by itself, and then you'd come somewhere else and do, write them again and do retained earnings. In a test format, this saves you from writing all this down twice. A little bit faster. That's part of why I like it, right? Saves some extra. Never work harder than you have to. Lazy, that's it. Hello, that's me. Questions? Yes, sir.
I have a question about the unearned revenue.
Yes.
If you wanted to make it look like you had more assets than you actually did in the reserve, what stops you from just inventing a fee, charging it from the unearned revenue, and then just charging the remainder of the balance at a lower rate?
Remember the 4 criteria?
Right, but if you just make up a fee and say, well, the fee is actually initiating the contract, and we have done that, so I'm going to go ahead and charge that. I'm going to charge 90% of the
Okay.
total.
But how does it help you?
Because you would have more assets than you.
Unearned revenue is a liability.
Right.
So I'm going to make my liability larger?
Or at least you're going to make it less, because you're going to charge it from unearned liability.
Then you're going to convert it to revenue is what you're saying.
Right.
Well, again, did I provide the service or the product to the customer?
Well, you would say that you did, because you would redefine what the service is.
Okay, so when the auditors come in and they look, they're going to say,
What costs are, and you can just cost it at a different rate.
I'm not sure what you're
Like if
trying
you
to
had
tell me there.
If you had a fee for $500, and then you were charging $100 per hour, what would it be unethical to charge $1,000 and charge $50 per hour?
Always charge what the market will bear.
Yeah, but
Okay.
it's like
So you're asking me what should I charge my clients, or am I misunderstanding?
What stops you from just coming up with an arbitrary fee to change that ratio?
Maybe I'm a little slow, but I'm not getting it. Okay, let me walk through it. Okay, I'm kind of slow, and I've got to write it on the board. So we've got unearned revenue, right? We're in some business where we've gone out, and the customer's given us $1,000 in cash, and we've recorded $1,000 in revenue. Let's say we're attorneys, and this is $100 an hour. That's 10 hours of services. Okay, so I want to pump up my profits and show less liabilities.
Right.
So all of a sudden I go and I say, well, I did 5 hours worth of work, but instead of charging them $500, I'm going to charge them the whole $1,000. I'm going to charge them $200 an hour.
Not exactly. I would say
Okay.
that there's like an $800 signing fee. So then I would say, well, you have signed a contract, so that's done. So we're going to record $800 of revenue. We'll charge the rest of it at a lower rate.
Okay, let me ask you a question. What does the contract say?
Right, but you could just change that if you're managing.
Hang on.
Sort of.
Your customer signed the contract. You can't just change the contract.
Well, wouldn't it be incentivized to build contracts with that already in it then? Would it cause that already in there? I wouldn't sign it.
All right. So in your scenario then,
Because they're paying the money up front anyway, so what do they really care about?
All right.
Internal reporting is?
let me see if I understand what you're saying.
Right,
Client gives me $1,000.
right.
In the contract, I have built in a $800 signing fee to the contract. So in reality, I get $1,000 in cash, I get $800 in revenue because he signed it, and I owe him $200 in services.
Right.
Okay, that's what the contract says. I can't arbitrarily change it. But I can build my contract to look like this. No problem.
Is there a better outlook for the financial statements than $1,000 of unearned revenue?
If your goal is to pump revenue up,
Right.
if you're an attorney and your goal is to pay less taxes, no.
Yeah, but if you had to balance it, if you had a lot of costs in that period and you wanted more revenue to offset it
Okay.
or something, you know, there could be a situation where you might want to do that. What stops you from doing that?
Whatever you build into the contract and you get the other party to agree to
You just-
is fair game. Okay?
I don't know why the other party would actually care how you know, what would stop them from signing that contract over the other one? Because either way, they're paying $1,000 up front. And
Yeah, you're an attorney. I won't get my cash back anyway.
well, you're not.
So I don't care?
You spend the retainer, right? That's why you're giving it to us.
Right. Well, attorneys have a really good way of always eating up the retainer, yeah.
Right.
So
So nothing really stops you, it's just the way you do it.
it's all based on how you structure the contract. And I'm fine with that. All right, other questions? Is it really that loud, the rain? Yes! That's awesome. Okay, questions, answers, anybody? All right, moving on. Eric. Okay, cash flows. Let me just throw up a statement of cash flows. We can kind of start to think about this a little bit. Now, a cash flow statement is designed not to tell you profitability, but to tell you cash that goes into a company or cash that leaves a company. Good? So when somebody buys a book from your store and they give you cash, that's good. Cash comes in. When you pay your utility bill with cash, cash goes out, right? So customers pay you for something, that's cash comes in. The bank pays you interest on your balance in your bank account, that's good. Yes, ma'am?
Is this something that small businesses do or only large businesses?
Tends to be larger businesses that are following accrual basis accounting. Okay? When you pay a supplier, cash goes out. When you pay your employees, cash goes out. When you pay interest on money you borrowed from the bank, cash goes out. When you pay your taxes, cash really goes out. Okay? So basically your revenues less your expenses gives you your cash flow from operation. Basically, modified by accounts receivable and payable and your prepaids and things like that. Okay? Investing activities. If we buy a new piece of equipment, cash goes where? Out. If we buy a building, cash goes out. If we sell a building, cash comes in. We sell a piece of equipment, cash comes in. Good? Financing activity. We go borrow money from the bank. Cash goes where? In. We issue more stock. Cash goes in. We pay dividends. Cash goes out. We pay off long-term debt. We go down to the bank and we pay them. Cash goes where? Out. We buy back our own stock. Cash goes where? Out. Good? Okay, real basic concepts. I'm going to work you into this one slowly. Questions? All right. Here's our fund ratio for the night. Hey, by the way, I didn't see a lot of you doing the ratio calculations for the first report that you guys turned in. I know when we get to one of the journals, I want you to turn in all the ratios. But, start doing the ratio analysis. If you wait till the end, it gets to be a little bit of a chore. Okay, just start early. So total asset turnover, sales or revenues, divided by average total assets. Notice the qualifier here, operating revenues. So if I sell a building, do those revenues, is it revenue? No, it's a gain, right? So gains and losses don't go into this. It's only operating revenues. Good? Average total assets. How do I get average total assets? Beginning assets plus ending assets divided by 2. Really straightforward. So what does this tell you? If I have $10 in assets invested in the company during the year, and I can generate $10 in sales from that, I get a number of 1, right? So I'm generating $1 in sale for every dollar in assets I have invested. If I have $10 in assets invested and I generate $100 in sales, this number is 10. So for every dollar of assets I have in the company, I can generate $10 in sales. The higher the number, the better. Good? Go? All right. You can stop.